Good evening, everyone, and thank you to all of you to be here. Thanks to the Finance Club for inviting me to speak and to um, speak on, especially in a topic which is, becoming uh, a buzzword. So the title, what I have done is that I have slightly modified it. And I'm very pleased to talk about this specific title. So initially it was, you must have received the invitation with respect to sustainable finance. So what I've done is that I have just added sustainable investment also in it. So the topic is sustainable finance and investment. It has become a buzzword, and what lies, what has made it a buzzword, and what lies beyond the buzz. So adding up the sustainable investment, basically it is something which is, kind of biased towards corporate finance, which I have been teaching for several years. So being corporate finance professor, we teach students that financing and investment are the two decisions that they go hand in hand, and basically we can consider them the two sides of the same coin. So that's why I thought that let's put it this way to be more clear that what actually I'm going to be talking about. Primarily, I will be looking at the sustainability in the context of both finance and investment, which are two important decisions that a corporate finance guy or financial manager per se has to take. So as professionals and academicians, we are all largely, concerned about the evolution in the field of sustainable finance and investments, particularly ever since the Paris Agreement has been signed by certain, signatories. So we are all concerned, and we have a role to play in this regard, especially in the context of the transition of the world, transition of the finance market, and the finance world per se towards a sustainable financial markets and sustainable financial world. So let me begin by providing you a helicopter view, or we can say kind of a suggestive insight as to why and how the sustainable finance is a buzzword. And this data basically reveals how the Google searches on ESG, particularly in the context of finance, they have evolved over the last 10 years. So the growth is impressive, you can clearly see, and it is widespread. So how Google searches on ESG, particularly the relative frequency, in a sense that we notice it has almost increased by more than 10 times, especially in the last 5 to 7 years. So this is an impressive growth, what we witness, and then how wider are the footprints of this interest, we can clearly see from this chart on the right hand side of my, the way I'm looking at it. So the interest by regions, you can clearly see that there is almost, everywhere we can find the footprints of the interest in sustainable finance and investment topics. So barely there is any region which is isolated from this specific interest in sustainable finance, ESG related topics across the world. So this is clearly a topic that is, we can say that it has reached not only the agenda of the investment community, but happily the mainstream agenda as well. Before I move to the next slide, let me just put a pointer so that it is quite easy for me to, highlight what I'm specifically talking about. So, and this push, what we are talking about, a surge in the topic specifically relating to the ESG topics and our growing attention, which it finds its roots in various corners, such as we can see the young Greta Thunberg from Sweden, who has engaged with politicians and business people around the world, using them to act as if uh, our own house is on fire, and which is actually the case according to, I mean, the whatever we have seen, the deterioration in the climate and the increase in the temperature over time. Then on the other side, we can also not to forget Mark Carney, who has been an ardent advocate of climate related issues, and now currently he is serving as a UN Special Envoy on climate actions. He has been his support towards the climate related issues. It comes ever since he was he was the governor of the Bank of England, and he has also spoken very frequently about the tragedy of the horizon, starting in a sense that this war is once this war is going to be over, maybe the challenge will be to create a planet that is going to be fit for our own grandchildren. Mark Carney has also urged the corporate world to support this transition when he said that if some companies and industries, they fail to adapt to the transition to the low carbon economy, they will fail to exist. Or in other words, we can say that they will be doomed. So this is a real, we can say that not only in the general sense, but also in the context of the corporate world, some general views, they clearly indicate that there is a potential threat. One specific thing which I would ask you not to forget and keep it in your mind is this guy in the middle, who we are going to talk about at the end. Maybe you already know him, so I will ask you who this guy is. So, but just keep that in your mind till the end. So, what is the significance of the topic? The chart that we can we see here on the right, we can clearly see that this is basically the latest World Economic Forum report that highlights that the environmental issues they have become prominent and they have taken place a space among the top 5 global issues relating to the risk. And in particular, we can see that the top 3 basically we can say the risk, most salient risk, they are coming from the environment side. And this is in terms of the overall impact that we are having. This specific chart is also correlating with the chart on your left that we are seeing, looking at the likelihood of the risk. Again, environmental issues, they represent 3 out of the top 5 most important risk identified in the World Economic Forum report. So it is very interesting to contrast these themes with those specifically, if we look back to the reports a decade ago, maybe around the 2008 financial crisis, that how the significance or the salience of various types of risk, it has evolved over time. Then another important way or another important dimension through which we can also look at it is this 2017 waterproof report that explored the potential of a changing climate on climate related claims. So based on scenarios from the Intergovernmental Panel on Climate Change, the Dutch Meteorological Institute, they have developed a climate scenario from for the Netherlands basically for a 1.5 degree centigrade and 3.5 degree centigrade temperature rise in 2085. So it's a very long-term forecast, but it provides really a very important insight into how significant is this issue. So all scenarios, basically, if you look at, they show that there is a significant, increase in climate-related claims as a result of climate change, which are expected to take place. So how do we basically define sustainable finance, having known about the significance and its connectivity, particularly in the context of climate finance? But there is something with the definition of sustainable finance which will be clear to us, that it's something which is not really only confined to the environmental related issues. So the sustainable finance generally refers to the practice of taking due consideration of environmental, social, and governance specific factors while making financing and investment decisions, which would lead to more sustainable economic activities and projects in the future. In terms of the participants, so we can clearly see that there are three major groups of participants which operate on both sides. Either they are the lenders or investors per se, and on the other side, those who are in the shortage of capital or in shortage of liquidity, they act as the borrowers. So clearly we have a role from the multilateral, institutions, sovereigns, supranational institutions, and municipal authorities to basically facilitate the market, and also to come up with the regulations, and to supervise the market, to regulate the market, etc. And then we have the banks and financial institutions. And last but not the least is the corporate. So these are the major participants, but of course later, we can also expand it towards the individual investors also, the general public basically. So what lies behind this this sustainable finance is primarily the ESG, the broader ESG framework, which we can clearly see here, that it contains three major pillars, primarily environmental, social, and governance. So these E, S, and G, they are part of the wider ESG framework, and in practice, often such topics, they span more than one of these three factors. So it means that it's not necessary that if we are focusing on environment, that is going to work in isolation or in silo. Rather, it is going to have some effect on social and also the governance aspect of it. So they are highly interconnected with each other. So looking at this underlying framework, we can say that the scope of sustainable finance is broad, as it comprises not only environmental protection, but above all, the questions whether a company will continue its operations in the upcoming year and will generate lasting profits or not. So for instance, dealing with the employees in a sustainable manner, and building incentive systems to promote the behavior in line with the sustainability strategy could be, we can take as an example. Again, another example could be that if, for instance, we are talking about, as I said, that they do not really work in silos. So if we are talking about, let's say, the climate change, and the climate change is clearly an environmental issue, but the necessary transition to a lower carbon world, so we can meet so that we can comply with the Paris Agreement, it will definitely have social implications also, and both on firms, industries, and individuals also. So the firms and industries, they will definitely, in order to comply with this low carbon emission targets, they will have to adjust to these new changes. So the jobs will be, of course, impacted, and they are either created or they are going to be lost. So in that case, we can deduce from this thing that these pillars, they do not work in silos. Rather, there is a greater interlinkage or interconnectivity between these three pillars of the ESG. So where do we stand with respect to the sustainable finance and investment? I will show you certain figures, certain charts which are going to give you an insight with respect to both the financing and investment activity that what is happening across the world. So the sustainable investing is on the rise globally, which we can clearly see with the assets under management having surged from 30.7 trillion in 2018 to 35.3 trillion by the end of 2020. And we can clearly see that here the US is the major contributor with 48%, while the second place is consisting with the norms is staying with the European region with 34%. So it's a huge basically portfolio of assets which is under the management currently that is specific to sustainable investing across the world. Again, another chart which is also giving you a different insight. The enthusiasm for climate friendly investing, it hits kind of a fever pitch, resulting in the pumping of a huge amount of cash into anything that basically looks like green. So what is the outcome of it? Basically, that outcome is that the valuations of different eco-friendly companies, they have gone they have taken an accelerated pace, and they are we can really call them they have increased in a crazy manner. And this is something which has been marked by several investment bankers, several asset fund managers, and also this is a kind of a concern which has been raised by certain other corporations as well. Another insight, which is with respect to the S&P Global Clean Energy Index, which tracks the share price of 30 companies. It has also, we can clearly see that it has almost doubled in value in the past years, giving its valuation of 41 times its company's expected profits. So this is basically coming, the data is coming from the Bloomberg. And by contrast, if we look at the blue chip US stocks, so we can clearly see that they are lying way below the eco-friendly energy index. So the US blue chip stocks, they are up about 16% in the past year, and they are valued 23 times with respect to their forward earnings. So there is a clear difference with respect to price to earning ratio, and with respect to the surge in the prices of the stocks that we have noticed over time. And this is also, further substantiate this chart that a recent, this comes basically based on a recent paper by Morgan Stanley, which found that a basket of green stocks saw a huge rise in the PE multiple, and they have substantially increased by an average of almost 24 points over the period 2020, compared with the 2 points for the sector peers. Okay, so we can clearly see that how these sustainable equity funds, they have surged over the time with respect to their price to earnings. So that's basically the major push in their valuation that they have received in the last few years. Now, if we look at the trends from the emerging market also, they demonstrate an expansion in sustainable finance market with a strong rebound in ESG flows, both in the bond side and the equity fund sides. So on the back of this exceptional growth is, of course, these two major market, the debt market and the equity market. And the gross flows, if we talk about, let's say, the bond issuance, so the gross flows into the emerging market ESG related bonds, they were roughly around 190 billion in 2021, which is a huge amount. And this was against a leverage of almost $60 billion in the last 2 years. So this accounts for almost 40% of the total cumulative issuance, which was around $475 billion since 2015. So it's a huge significant amount, which is that this sharp acceleration in 2021 despite the pandemic, it comes after sustainable finance strategies became more important and more, acceptable and they have become mainstream part in the emerging markets. So even on the other side, if we look at the ESG equity flows on this specific side, we can clearly see that they stay at around $25 billion, which was slightly ahead of the record flows of 2020. So this is something which is again another kind of an indicator of a growing space that ESG related funds, ESG related instruments, be it bonds or be it equity funds, they are gaining in the emerging markets. So the cumulative, in the cumulative sense, it was $50 billion flows in the last 2 years that the equity market has received in the emerging markets. So this basically data is coming from a recent report by IMF on emerging market related, evaluation of the sustainable finance. Now, with respect to the regulatory front, I will specifically talk about there is lot basically that we could talk about, but I will quickly give you some perspective relating to in the context of the EU market, that the EU Commission has recognized the significance of sustainable finance, as we were talking about it in the beginning, that the government, the sovereigns, the regulators, it's their important role to monitor the market for the interest of the public, okay, for the interest of various stakeholders. So regulation is something, and disclosures are something which is an integral part of this monitoring mechanism. So the EU Commission has recognized the importance of sustainable finance by regulating the allocation of equity capital, for example, by providing guidelines for investment advice and also for the debt capital, also by providing guidelines relating to the calculation of risk-weighted assets. The EU Commission also wants to basically influence the incentives of the participants and the real economy. And this is something which is basically, again, driven by the policy relating to the climate Paris Agreement and the compliance relating to the UN 2030 Agenda for Sustainable Development. So in the European Union Commission, it has set up several working groups, such as the high-level expert groups on sustainable finance or the technical expert group on sustainable finance and investment. Then another important thing is to, in terms of when it comes to the definition of sustainable finance, what is acceptable relating to in terms of the activities which could be part of the sustainable finance, or those activities which are not, which we cannot take or consider as sustainable activities. It is very important to come up with a unified or uniform document that we call basically the taxonomy of the sustainable finance. So the European Commission has tabled or has introduced after passing a legislative relating to the development of a unified EU classification system, which we call the taxonomy of sustainable finance, to determine that which economic activities can be regarded as environmentally sustainable for investment purposes. And then there are several, when you look into these documents, basically there are huge documentation, huge with respect to the disclosure requirements, with respect to what could be considered, and also their alignment with respect to the IFRS regulations as well. So it's a huge subject basically, which primarily comes in the ambit of accounting and disclosure related fields. So this basically, after having this a perspective relating to the empirical or data-driven significance of sustainable finance, let me now give you some perspective on it from the lens of academia, that how the academics or the researchers basically they look at the sustainable finance. So this is primarily sustainable finance can be viewed through the lens of the CSR. And in this regard, there are two conflicting views that have been advanced so far by the researchers or by the academicians. So these two important theories you might have, it's just kind of refresher for you also, that you might definitely recall them, that the shareholders, the famous shareholders view theory and the stakeholders view. So what the shareholders view is, it tells us with respect to the CSR or the sustainable finance per se, that it is deeply rooted in neoclassical explanation, according to which the sole responsibility of a manager is to maximize the profit. So according to this, it was initially advanced by Friedman back in 1970s, and according to this theory, basically the ESG issues or anything relating to sustainability that can be settled by the market itself. So primarily the players or the participants, they don't have to, specifically the corporations, they don't have to really do anything about it. So it basically totally exonerates the shareholders from taking any actions or from considering sustainability as an important thing for its because their ultimate objective is to maximize the value. So within the boundaries of I mean, if it is not settled by, let's say, according to this theory, if it is not settled by the market itself, then the regulations, whatever they are permitting, or ultimately the government can fix these environment related or societal or governance related issues. Contrary to that, if we look at the stakeholders' view, so stakeholders' view claims that the corporate success and social welfare are not a zero-sum game. So according to this, the ESG focus of a firm may increase stakeholders' support towards its operations and therefore ultimately benefit shareholders. So in this way, the stakeholder view basically contend that ultimate beneficiary of, again, having an ESG focus are shareholders in that spirit. So therefore, the ultimate beneficiaries are the shareholders. So the CSR activities are often associated with a stronger reputation and a stronger commitment to honor implicit contracts between the shareholders and other stakeholders. So these are the two conflicting views. And then what we notice is that there is a plethora of research, especially in the past few years. The pace with which the research relating to the ESG specific topics in finance, it has significantly increased in especially last 5 to 7 years and so on. So here, well, I mean, I can put several results in front of you, but due to the shortage of time, I will quickly talk about few important studies, and then I will there are a couple of other things to talk about, and I will wrap it up then. So as I said, that the sustainable finance is a recent and growing area of scholarship in finance. So one study which was published in JFE back in 2021 by Aramov et al. So what it contends that the ESG uncertainty affects the risk-return trade-off for the investors. So this recent study basically defined that the market premium increases and demand for stocks, it declines under the ESG uncertainty. So in addition to that, they also find that the CAPM, or the capital asset pricing model, if you recall this, your favorite model in corporate finance, so the alpha and the effective beta, both, they rise with the ESG uncertainty. Then there is another study by Bolton and Kasperczyk. So according to this study, they basically investigate whether the carbon risk emissions, they affect the cross section of the US stock returns or not. So what they found is that the stocks of firms with higher total carbon dioxide emissions and the changes in emissions, they earn higher returns. So it could be on the face of it, it could be surprising that how come these, more carbon emitting stocks, they earn high return. But if you intuitively see that, it perfectly makes sense, because it is consistent with an interpretation that investors actually, they are already demanding compensation for their exposure to carbon emission related risk. So this is something which is perfectly in line with the risk and return trade-off theory, that higher the risk, higher will be the return. So since the investor, they see that there is in certain equities which are primarily coming from, let's say, polluting industries, they are bearing more carbon emission related risk, so they are seeking more return in that regard. Then there is another study, which is basically a survey-based study that was conducted by Kruger et al. And again, a very good paper, which was published in Review of Financial Studies back in 2020. So they conduct a survey about climate risk perceptions. And they also show that institutional investors, they believe that climate risk have financial implications for their investment portfolios. So many of these investors, they especially the long-term, larger, and ESG-oriented ones, they consider risk management and engagement rather than divestment. So this is something which is important in a sense that despite having, the risk implications, those investors, they don't think of, an exit strategy from these ESG-oriented funds. Rather, they thought of, or they are planning to, they consider managing those risks in an appropriate manner. So that's something which is quite insightful. A recent paper which actually I have written with my co-authors. So what we do in, so it's something which is not really specific to the debt and equity market, but again, it looks at the implications with respect to the shareholders. But in this specific paper, what we are looking at is that we are analyzing the mergers and acquisition activity at country level, and we try to see the footprints of the country level environmental sustainability differences, that how do they drive the M&A activity. So we are using 34,088 cross-border M&A across 45 countries. And what we found is that the greater ES differences, or environmental sustainability differences, they stimulate the intensity of cross-border M&A activity between the acquirer and target nations. So particularly in this study, what we show is that the acquirer firms, they experience a higher cumulative abnormal return around the merger announcement, and they also pay high merger premium. So this is basically high merger premium. We can think of it in the context of, that the target shareholders, if they know that the acquirer is, transferring or shifting the polluting activity towards the destination country or the host country, then they would tend to seek a higher, premium or higher compensation for that. So consistent with the pollution haven hypothesis, our results in this study, we show that they are more pronounced, the value effects especially, they are more pronounced in the context of those M&A deals which are basically done in highly polluting industries such as, petroleum, transportation and mining sector. So this is something, so this is, kind of quick insight with respect to the empirical research which has been done with respect to the sustainable finance and investment. Now, if you remember that I told you to not to forget this guy. So this was for some purpose in the middle. I mean, if you recall the first few slides, so he was in the middle, but now I have pushed him on the side. So I don't know if you already have some idea who this guy is. Anyone? No ideas? So his name is, I don't know if someone is working in, let me ask another question. Someone who is working in Total Energies?
Yeah. No, he's not. We've got someone working Total Energies, but he's not with us today. So.
Okay, okay. So this guy, he's sorry.
Is he maybe the president of Total Energies?
Yeah, so he is Patrick Poyonne, if I'm pronouncing correctly. Apologies for my poor French, but he is a CEO of Total Energies. So now, after talking about the benefits, the significance, and although we have already started talking about the downside of an emphasis on sustainable finance, sustainable investing. So now I am moving towards, or we are moving towards, the downside or the implications, or maybe an overemphasis. What could be the implications of this overemphasis? Whether this focus on the sustainable finance is balanced one, or it's an overemphasized. Just like if you recall what happened around the tech bubble. So the tech bubble, I mean, we know its fate, that it got burst in 2000, okay? And the same was happening, that there were huge market valuations of the tech companies. And there was a time that investment bankers, they forgot their suits, and they used to just to please the tech firms, they used to wear, they have started wearing jeans and t-shirts, to align their taste with the technology company. So technology companies. So the reason of putting Patrick here is basically that he warned about the green bubble, that where we are actually heading. So there are several, it's not only Patrick Poyonne, but there are several investment bankers, several fund managers who either during the jobs or after the jobs, they spoke about some cautions, and you can find plethora of articles on this, that whether we are heading towards a green bubble or we are already living in a green bubble. So he basically warned that we are actually moving towards a green bubble that has led to a string of deals with the crazy market valuations in renewable energy sector in particular. And this is something which we have already seen in the charts. And he was unapologetic about the need to develop the Total's fossil fuel business to help generate cash for the green investment. So this is something which is important in the context of the greenwashing, where we know that certain companies, they may misreport their ESG activities. And then we also have another person with us, who is Emmanuel Fabers, and his story also is quite instructive in a sense that how the shareholders, they can play a role in the sustainable finance or emphasis on the ESG activities. So Emmanuel Faber was a former CEO of Danone, and he was removed after the shareholders' displeasure or complaints about the underperformance, financial underperformance, basically. So Danone is a company, we know that it is considered to be deeply committed to social purposes, but nevertheless, it was under pressure to improve financial returns, including from an activist shareholder who was actually committed to the ESG activities, which ultimately led to the departure of Emmanuel Faber last year probably. And last but not the least is this guy, Tariq Fancy, who is a former global chief investment officer for sustainable investing at BlackRock. And he stated that sustainable investment too often boils down to little more than marketing hype and disingenuous promises amid a series of high-profile scandals, such as regulatory probe into fund firm, for instance, DWS, on whether it misled the clients about its sustainable investing activities, It has also now raised fears that some of the bolder green claims made by asset managers could amount to mis-selling in the market. Recently, there was a report by Morningstar in which they stated that they have cut down almost 1,200 investment funds with assets of roughly around $1.4 trillion from their list of sustainable investment after an extensive review of their global legal documents which were made available to them. So this is something which is very important, and it shows us basically that how there are certain, what are the significance which is with respect to the disclosures and reporting, that we have to be very carefully monitoring the various reports that these companies or these funds they are basically submitting for their, to win the customers, to win the investors, or to win the appeal for the specific funds or for the investment opportunities. So this is a word of caution basically, which is with respect to the green bubble that has been raised recently by several, from several corners, and that also entails, or that also require tighter, monitoring of the ESG related sustainable finance and sustainable investment activities. So these are some major sources which I have used basically, but just to conclude, ESG analysis, we can say, or sustainable finance per se, we can say that it's far from just a nice to read, nice to see, and nice to have kind of buzzword. It is critical means for helping to better manage the risk, meet the market demand, and fulfill investors, investors related obligations. So we are clearly seeing an increase in the number of sustainable investment opportunities, and it is therefore essential that asset managers or asset owners, they spend time to map out and execute their responsible investment and financing strategies in an appropriate way. So as we have discussed, the manager's selection is a crucial part of making this a success. So to conclude, putting sustainability at the heart of the capital markets, we can help ensure that the capital flows are channeled into investments that aid future growth and protect our economies and societies. So not just for the sake of their own the benefits of the current generation, but also for the future generation as well. So what could be more important than that, basically, that we are taking care of as it was, in the first few slides I showed you about the concern which was raised by Mark Carney about the grandchildren. So this is all about what I hope that I was able to respect time. So thank you all for your time today, and now I will turn back to Violaine, and looking forward to any comments, views, or any questions if you have. Thank you.
Thank you very much, Saqib. We had a few comments by Jack Paul in the conversation.
I hope I was on time, first thing. Huh?
Yeah, you were on time because we started a bit late, so that's perfect timing.
Super.
We see that
Thank you.
You are experienced. Do you have other questions or a comment that you would like to share with the group or ask to Saqib? If you want, you can turn on your mic.
Yes, I do. I want to thank you, first of all, for this interview. I thought that the subject was very interesting. And I'm very also interested in this subject because I'm working in a company that is specialized in green investments funds. And I am writing my GP on this subject. So I found it to be really interesting. And I was wondering if you had any maybe additional reading recommendations, Mr. Saqib.
Sure. I mean, so if you could share with me some details about your, graduating project, so I can. I mean, there is basically, in terms of if you are looking at the research articles, so there are, as I said, that there is a growing interest. There are a lot of good articles which have been published, and top of it, there are variety of reports which have been, published from different corners. Okay, you can find reports from different audit firms, the top audit firms. You can find reports relating to sustainable finance and investing from IMF, from OECD. So there is a huge material.
Okay.
Just I mean, just to give you some, to prepare this 30 minutes report. So I went through all this 30 minutes presentation. So and so you can imagine that how rich is the material. So you can share with me the details, and I will definitely come back to you with some appropriate references.
Okay, great. Thank you very much.
You're welcome.
I see that Anna is typing. If you have other
comments.
comments.
So Jack Paul mentioned that war is not on the chart.
No, that was sort of a bad
so
joke.
Since
But it was actually because you had weapons of mass destruction on the left of the chart. It's probably going to move right a bit due to the latest news. I've got one question, and I find the comment on the M&A activity quite interesting. In that study, did you find that some of the mergers were just done to buy some green? What would I say? Some green credit, or did you see mergers whereby if it wasn't for the fact that the target was full of green stuff, it wouldn't have made sense from a purely economical point of view?
Okay,
this is just the cherry on the green cherry on the cake.
So in this specific study, it's a very important point actually, Jack Paul. Thank you for raising it. So in this specific case, what we have looked at is basically that how the country level environmental sustainability emphasis, it attracts, M&A activity, or it drives the M&A activity. So this specific, whether if a target is having a greater focus on ESG, so that's something which is kind of another work in progress, where we are actually looking at it. So I have revealed a secret to you. So this is an upcoming paper that we are currently working on, but it reminds me of another study which has recently been published in the Journal of Corporate Finance, and that does not really look at the environment or green specific thing, but it looks at the broader CSR activities. So again, in that, what they have looked at is that whether the acquirer emphasis on the CSR, it reduces the M&A uncertainty or not. But they do not look at the angle of the target, or the target viewpoint, that the target emphasis on the CSR or target emphasis on the component of the CSR, how does it affect the M&A completion or affects the shareholders' value. So this is something which is very important aspect, which we are actually looking at in another paper.
Thanks.
Okay.
Anna would like to know if you will be okay to share your presentation. But anyway, there will be the replay of your talk. So if people want to see it again,
I will share the presentation later.
Okay, thank you.
Okay.
And
so, any other questions, comments?
Seems to be perfect. No other comments.
Okay. Yeah, and don't worry. I mean, if we weren't that many today, this is a topic that's not going to disappear. So we can have a sort of annual conference, club finance conference on it, and it will certainly grow in interest. So don't be sort of afraid that not many people turned up today, but I'm pretty sure that the ball has started rolling, and that will gather, no doubt, momentum in the future.
Absolutely, yeah. There are, I mean, there are several, implications of this, focus on sustainable finance. There are the good parts, the also, the what I alerted about the bubble thing. So that's something which is, very importantly being observed or being monitored. So definitely the students, I think that there is a lot that they can learn, and one thing that specifically for these participants could be of interest in terms of their future careers, is that there is a certification which is provided by GARP. GARP is a Global Association of Risk Professional. So they have a broader certification of financial risk management, but now they have given the importance of sustainable finance and sustainable investing. They have introduced a certification relating to sustainability and the risk management. So you might think of looking at it just to sharpen your skill. You prepare, get the certification, and it makes your career more promising.
Yeah, and we'll have a Red School of Business one soon.
Yeah. Okay, great.
So great. I will stop the recording. Thank you, everyone.